be using. And and these two handouts, these are optional. If you're gonna do these, there's extra credit involved, but you don't have to do them, but if you want to, you can. All right, so let's get started. Let's start off with the syllabus. And you should have this. If you don't, it's also in Blackboard under the syllabus here. My business course and the syllabus goes together. All right. Contact information. This is the Zoom meeting, which obviously I don't need to show you guys. You already are here. My business course. And if you do this, if you go right to the publisher, I think it's significantly cheaper than going through the bookstore. And you can decide whether you want the textbook or not. I think there's two options, maybe even more, but there's an option for access code, and then there's an option for access code and the ebook. Now it's up to you whether you want to get the ebook or not. You need the access code because that's the way all the assignments are going to be in their website, basically. But as far as needing the textbook, the ebook, and I'm not sure how much extra it is. I think it's like, I'll say something stupid, but I think like 30 or 40 bucks extra to get the ebook. And it's up to you whether you want to do this or not. The one thing I will tell you about accounting in general that's kind of nice is that it's uniform. So even a lot of times you can even look it up just Googling it and get the information you need. But the textbook obviously will go along more precisely than the rest of the internet. Okay, but I think the cheapest for the access code I think is $90. I think. Okay, learning outcomes. You guys can read that. Be bored. Here's the grading for the class. And the homework is 60%. If you come down here, it kind of breaks it out. It's 12 chapters, and the homework assignments are 50 points for each chapter. Some chapters have, I think, 2 homework problems. Some chapters have 4 or 5. But regardless, they're 50 points a chapter. So 12 of them, 600 points, and then each of the exams is 100. And I'm going to skip this for a second and come down here. So the first exam is chapters 1, 2, and 3. Second exam is 4, 5, 6. Third exam is, you get the idea. Every 3 chapters, there's an exam, 4 exams. Okay, coming back here. So there's a total of 1,000 points in the class. So your goal here is to get $930 points. So that's kind of the goal for the class. I think for what people going, you want to get the A, it's 930 points. Now, there is optional extra credit, and that's these Zoom meetings. And these Zoom meetings will be 2 chapters a week. And each chapter handout you turn in is worth 10 extra credit points. But the point being is that you can get a total of 120 extra credit points going towards that 930. So it is possible even that you could knock off the last test if you turn in all the extra credit points, because tests are worth 100 and you can get 120 on the extra credit points. Question on that? Okay, and so here you can look through this, and I think these are policies and that down below. So you're shooting for 930 points, and 60% of it's the homework, and the other 40% are the exams. And you get these extra credit points. Okay, so let's see let's go to Blackboard. So we did syllabus, let's go to Blackboard. It's not Blackboard, this is Blackboard. Okay, so Blackboard. If you go in these first, let me get student view. So mine looks like yours. These first three on the side underneath announcements are kind of where you're going to live. I'm going to do the last one first because it's the least. And this is just links to that you might use: Microsoft Word, Excel, PowerPoint, tech support. If you have a problem with your anything with your account, click on tech support. The Roosevelt calendar, this will have a calendar for, well, let's just click on it just to. So this will have the calendar for summer. But you can click on any of these. And part of my reason for putting these on there, sometimes students will say, oh, I don't have this on my computer, I don't have Microsoft Word or whatever. Well, you do. It's just, it's at least on the browser form. You click on that bookstore, blah, blah, blah. So these are just kind of handy links to have. Okay, let's go over these optional Zoom meeting extra credit points. If you want to do it, you don't have to, obviously. And you'll see that each week we do 2 chapters. And I have a week 7 here lined up in case we need it. Now, when you're done with it, you're going to submit it here. So let's say tonight you finish up chapters 1 and 2. You're going to come in here and under chapter 1, you're going to submit it. And chapter 2, you're going to submit that also. So this is where you submit the extra credit points. This is where the recorded meetings are, and you'll notice there aren't any because this meeting hasn't been recorded yet, but when it is, the Zoom meetings take a little time to get put in for a couple of reasons. First of all, they need to get edited. You got to cut them up to make them. It's a long story. YouTube, if there's too much blank space in YouTube doesn't do the closed captioning, which we need to have for American Disabilities Act. So you got to edit the ends of it so that there is this closed captioning. Anyway, I put it through my editor. That takes about an hour usually, and then I submit it into YouTube, and that usually takes another hour. Generally speaking, most of the time the videos will be in by 11 o'clock at night, but it is possible that they don't get in until the next day. And that's is just because of YouTube. You know, it's the delay in YouTube, which obviously can't control. Okay, so the recorded meetings will be in, I think I put that in. Yeah, I say that they'll be up by Wednesday, the next day, but usually it's earlier than that. And here's all the files. Here's the 12 files that we'll be doing for the extra credit points. So this whole Zoom folder kind of thing is for the extra credit and the weekly meetings. And if you're not really familiar with accounting, it may not be a bad idea to tune in, or you can also just look at the videos. So if you can't make it to the class or you got stuff to do or whatever, if you watch the videos, you can still get the extra credit points. So don't think, oh, I can't do it. I can't get those extra credit points because I can't attend on Tuesday. You can just watch the video and it'll kind of walk you through and you can turn those assignments in. Okay. My business course link. Now, if you haven't purchased it yet, you can click on here and this should bring you to where to purchase it. And I'm not sure if you guys see get this or not. Mine automatically signs me in for some reason. Sometimes it does, sometimes it doesn't. But anyway, if you are already signed in, if you click on dashboard, it'll come up. The class it should come up to Accounting 405. And so this is the course. It's I can move this. It's a little bit confusing when you look at it, but if you go to course content, this is where everything is. So course content is kind of what you want to click on. This is where we're going to spend most of our time. And here are the chapters for the homework. So after we get, after tonight, you want to try your homework, chapter 1 and chapter 2. You can do it. Let's click on it just for kicks. Yeah, so here we have problem 1, problem 2, problem 3. I guess I don't need to count them out for you. But anyway, so that's it. The exams are here. Chapter 1, 2, and 3 is the first one, and so on and so forth. And it's set up so you get 5 chances. Everything basically is set up so you get 5 chances to do it. So if you get a score you don't like, or you weren't ready, or whatever, you can do it again. And you have 5 chances to do that. If for some strange reason you need more, let me know. Sometimes people have clicked on it and whatever, the count started and they never even got one in. So if that happens, or if something weird happens with the count, don't think that you're just out of luck. Just send me an email and I can reset it.
I have a question.
Yes.
My name's Jasmine, by the way. Nice to meet you.
Thank you.
I was just wondering, once we have to, like, basically once the exam is open or once it's due, do we have a certain amount of time for, like, is there a time frame within, like, we have to take it, if that makes sense?
Yeah, no, this, you can take as much time as you want, and you have until you have 5 tries on it. They're not timed. Let me check just to make sure, but I'm virtually positive those are not timed. I did not put a time on.
Okay, so you can take it whenever, basically.
Yeah. Attempts. Blah, blah, blah. Yeah, timing. No time limit.
Okay, thank you.
Okay, yeah, so there's no time limit on the test. And two, the important thing is to learn the stuff. So if there does come up a question on the exam that you're not familiar with, or maybe it wasn't exactly what we covered in homework or in the handouts, Google it, or look in the textbook, obviously, if you have the textbook, but also you can Google it. That's all part of learning too. So yeah, so there's no time limit on that. And again, you get 5 chances on it. So yeah, for the most part, people don't have too much of trouble with that. Okay. And I think that's it for that. Oh, there is a quirky thing right now. Exit this one. There is a quirky thing right now that I should probably talk about really quickly, and that is we're still trying to link up the My Business course with Blackboard. So right now, your grades for the course will be in My Business course. Your extra credit points for the Zoom meetings will be in Blackboard. They'll be separated. Now, hopefully, tomorrow we have a meeting at 2:00 that hopefully this will get sorted out, but that they'll be linked up. We have had trouble this last couple of weeks trying to get it hooked up, but hopefully by tomorrow it will be. I'd like to have it so it's hooked up so that immediately when you take a test or turn in homework or whatever in My Business course, that it immediately shows up in Blackboard along with your extra credit points, so you kind of keep track of it. But the way it is right now is going to be grading your My Business course, and you have to kind of add in your points from the extra credit points, which will be in Blackboard. But they will all be in Blackboard regardless of whether it's linked up soon or not, because I will put it in there manually starting if we can't get it working tomorrow. I'll start doing it manually, But there might be a lag in that because it's not immediate. If you complete an assignment on Thursday, and if I don't manually put those in by like say Saturday, you're going to have that day and 2 days or whatever lag between it being in my business course and it being in Blackboard. Hopefully that won't be a problem, but I'm just kind of giving you a heads up that it could be. Okay. Let's go ahead and I'll tell you what, we'll go ahead and get started on the handouts. And again, if you're familiar with accounting, if maybe you've had it recently, these are options. You don't have to do it. If you're not really familiar, or maybe it's been a while, maybe, okay, yeah, I had it, but it was 10 years ago or whatever. It's really it's here to help. So these handouts they're not required. You do get extra credit points, but they're really kind of here just to kind of get you started along the line, maybe in a little easier way than chugging through the book. Okay. Now I'm going to do something terrible. I'm going to show you something that you don't have in yours, but this is kind of what we're going to cover today. We're going to go over some of the accounts that we use. We're going to go over these 3 financial statements, and don't worry about those right now. And the statement of cash flows is not going to be covered until chapter 3. Now, these are the basic financial statements for a business. So tonight, we're going to go over these 3 in this first handout here. Okay. So we're just going to cover the statements, basically the 3 statements we're going to cover. And then we're going to jump right in. You really kind of learn this more doing it than going through it here. But the income statement, you basically compare what comes in with what goes out. And what's left over is your profit. How much money did you make? So if $20 came in and $12 went out, you made what? 8? I should have this worked out better. Whatever comes in, you subtract out what went out, and whatever's left over, that's the profit you made. Statement of retained earnings is kind of wacky. It's kind of like an owner's piggy bank, which I'll talk about. I'm just going to do this when we do the next page. But basically, you have a piggy bank, and any profit you make is added into the piggy bank. Any money taken out comes out of the piggy bank. Okay. The balance sheet. It's split up into 3 different categories. The first one is assets. An asset is anything with value. Cash, inventory, furniture, equipment, blah, blah, blah. Assets are basically, when you look at a company, that's what you see. If you look at Walmart, what do you see? You see the building, that's an asset. You see their merchandise, their inventory, that's an asset. Their shelving, that's an asset. The parking lot and land, that's an asset. So anything with a value is an asset. So when you look at a company, you're basically looking at the assets for the most part. And virtually all the businesses you're going to look at are going to be like, if you look at an auto company, what are their assets? Well, it's the manufacturing plant, it's the inventory inside, it's the land, the parking lot, all that kind of stuff. So assets are basically what you see. There are some you don't see, but for a large part, the stuff you see are going to be the assets. Liability, that's money owed to the outsiders. If you owe somebody, you owe a bank a loan, you owe a vendor money, if you owe employees money, anything that is owed to somebody who is not an owner of the company is going to be in this liability area. And you'll notice that most of these, in fact, you're going to find have this magic word payable behind them, meaning you got to pay it. And equity is the owners. So liability is what we owe other people. Equity is what the owners own. And it kind of tells you where you get these assets. Assets just don't appear out of thin air. How do you get them? Well, there's only two ways to do it. You can either borrow the money or the owners have it, or some combination of it. So for instance, if you buy a car for $20,000 and you put a down payment of $5,000, it would look like this. 20. Oops, that's too much. It would not look like that. I'm lying to you guys. Be 20,000. You got a loan for 15,000. And the owner, if you made a $5,000 down payment, it would look like that. You got a $20,000 asset, the car. You owe 15,000. You kicked in 5,000 for it. Okay, now down below here is a big laundry list of stuff that can go under each of these. We're not going to get into this. We don't need it. But if you're ever wondering, if you run into an account that you're not sure what it is, you can come down here and take a look at it. So if you hear the word copyright, where does that go? It's an asset. And if you find the word whatever, unearned revenue, liability. So we're not going to get into it. We don't need it for what we're doing. Okay, let's get right into the problem. Okay, income statement. Oh, by the way, this is a pig we're going to talk about later. There's a piggy bank. All right, income statement. This is where we're going to bring money that comes in versus money that goes out. All right, so let's look at the first thing on the income statement. This is off of page 1. I'm going to zoom in here. So on page 1, the first thing on our income statement is going to be revenues or sales. So what do we have for revenues or sales? Hey, are you guys sleeping already?
No.
Yep, 55. Yeah, so we have revenues of $54,000. So this is money coming in. Now going back here, we don't have any cost of goods sold, but we do have expenses. So this is money going out. So we're going to look at the expenses that we have. And here's the two expenses. We have rent expense, salaries expense. A big part of this, if you're not familiar with the, accounting, is that learning the terminology. Okay, so there's money going out. So we have 9,600 going out, and salaries expense was 19,800. Okay, so this is money going out. Oops. So 54,000 came in, 9,600 and 19,800 went out. And I'm going to sum those. So this is our net income. Which is what we call profit. Actually, it's profit, but we call it net income. I said that backwards. And this is really the important number when you're looking at the income statement is how much income did they make? Now, sometimes people look at the revenues because they're the biggest number. But the number that is really the most important is going to be that net income. Okay, statement of retained earnings. As you may have guessed, this retained earnings is on the statement of retained earnings. So I'm going to put that on here. This is the beginning retained earnings. And that is 30,000. Okay, so over here, this is kind of what like retained earnings. Retained earnings is sort of like a piggy bank. Piggy bank, one word.
I think it's two.
My wife was a English professor, so I get spelled that a lot. Okay, so here's what happens with this. So we start out with 30,000 in our piggy bank. Now we made some net income here. Oops, let's try that again. Made some net income here. So this net income will increase our piggy bank. We have 30,000 plus we just put 24,000 in. Now we also have these dividends declared. And let's make those a different color. Let's make those that color. Now, these dividends declared are money going out. So when the owners take money out, they take money out of their piggy bank, to live on basically. And then whatever's left over, that's the ending amount in the piggy bank. So this is and I'm going to add that up. Okay, so this is the beginning amount. And this is the ending. Oops. Hold on a second. Okay. Part of the fun of this class is watching me learn how to use a computer. Okay, so this is our ending amount that we have in our piggy bank. Okay, so coming over here, so this is what we're going to do. We're going to have the net income. That's not the right number. That is. And we're going to have the cash dividends declared. Now, this is a negative number, though. This is the amount that they have taken out of their piggy bank. So this will be our ending retained earnings. So the owners still have $5,200 in the retained earnings at the end. Oops. So they can still take out $52,200 out of their piggy bank. Here's a question for you. If the piggy bank is empty, there's zero in the piggy bank, how much can the owners take out?
Nothing.
Yeah, zero. So if there's nothing in the piggy bank, they don't get to pay dividends. So dividends come out of retained earnings. Okay, so let's come up here. Now we're gonna look for assets, and assets are, this is on the balance sheet, by the way. You hear that barking in the background? Those are my cats. All right, so the balance sheet, we have assets, and assets are anything with value. Okay, so what assets do we have? What has a value?
Equipment.
Yep. So equipment certainly has a value. Oops. And one more thing. Yep.
Cash.
Yep. Very good. And cash. So cash and equipment both have values. So those are going to be assets. Let's see it. Okay. Now liabilities. Liabilities are when we owe people money. And way back here, you'll notice that they all have that magic word. Oops. Magic word, payable. So whenever you see a payable, that's a liability. And in this case, we have accounts payable. I should probably just copy that, right? Save time. Hey, it worked. So anytime you see payable, it's going to be a liability. There's other ones too, but payable is definitely one of them that we have for liabilities. Okay, now there's one sad, lonely account that we haven't used yet. Which one is it?
The common stock.
Yeah. Yep. So this common stock, this is what the owners have invested in the company. So the owners have put $4,800 into the company. Now that I did mess up the something here. All right. Now they also have their piggy bank, retained earnings. So the owners also have this retained earning, this piggy bank. And that is the wrong number. Okay, so let's go through here and see how this all works out. I'm going to insert a row or two here. I didn't space mine very well. Hopefully you're better at spacing than me. Okay, we come over here, we add up our assets, we'll say total assets. And we'll add those up. Okay, so here are the total assets. We'll make that. Look. Okay, we're also going to have our total liabilities. Now, total liabilities, we only have one. So this is going to look a little silly, but. And you know, you may ask, do we need, you know, is that really necessary? Probably not, but if there's more than one liability, you want to total them up. And then down here, we'll have total equity. Now, if you add up the total liabilities and the total equity, it should come out to equal the same as the total assets, and it does. So I'm going to say equals. Yeah, oops. Finish my formula. Okay, so 57,000 plus 3,000 comes out to 60,000. And so this explains how they got the 60,000 worth of assets. So they got 60,000 worth of assets. They didn't just appear out of blue air, thin air. They're colored blue right now, but they didn't just appear out of thin air. You know, where do they come from? Well, they borrowed some money. How much money did they borrow? So they got the 60,000 worth of assets. Some of it they borrowed. How much did they borrow? I'll give you two choices: liabilities or equity.
I say 3,000.
Yep. They borrowed this much. And the owners kicked in this much. That's how you got those assets. They borrowed 3,000, the owners kicked in 57,000, and so that's how they got that 60,000 of assets. So if you're wondering why the balance sheet balances, these two will, or they should, it's because you're explaining how they got these assets. They got these assets by borrowing 3,000, and the owners kicked in 57,000. Okay, let's go ahead and do this one. Page, well, first of all, any questions on this one on page 1? I'll get screenshots of it. Make sure you get a screenshot of that pig. Okay, I guess the pig isn't that important. The pig won't be on the test.
Can you go back up so I can screenshot? I'm sorry.
Yep.
Okay, I'm good.
Okay. Yeah, so that's problem 1. We'll go ahead and do problem 2, I guess. Okay, there's not too much new on this page. It's in a little bit different order. The new account here, these expenses are just expenses are expenses. They're just the same thing. We have access to the spreadsheet. Not right now. The spreadsheet, no. The spreadsheet will. I mean, other than just taking the picture of it now. But and this goes back to here. You can pull this up though, even if you don't have it on your computer. If you pull up the Microsoft Excel, let's just pull it up. See. And hopefully you don't have as much stuff as I got on here. Oh, here, I'm sorry, upload. And then you can upload it into here. So there's one we just did. Here's the second one. So everybody has access to to Excel. You can pull it up in there, even if you don't have it on your computer. You can, and it should work with Apple too, hopefully. Okay. Well, let's just kind of go through this one, and we'll leave this accounts receivable one till later. We'll talk about that one later. It does work on. Okay, good. Okay, so let's do our income statement. What are we gonna start out with? I'll tell you what, you guys are smart. I'll let you guys kind of work through it, and I'll kind of work through it too.
Accounts receivable.
Well, accounts receivable is when somebody owes us money. Accounts receivable, I'm going to put in right now. Accounts receivable is going to be an asset. And here's why. This is when someone owes us money. So accounts payable is when we owe somebody else. Accounts receivable is when we're going to receive it. So payable, we have to pay. Receivable, we're going to receive. It's an asset because this is going to turn into cash. The accounts receivable, when they pay it off, whoever it is, it will turn into cash. So we count that as an asset. So accounts receivable is going to go down here, along with cash. Any other asset? I don't think there's any other assets. Now, this is kind of jumping ahead a little bit. Accounts receivable do match up with revenues. Because usually what happens is somebody buys something on credit. So usually, I know why you're saying it was on the income statement, because they kind of go hand in hand. We're going to talk about that next chapter. But revenues is when you sell something to somebody and there is a sale, and this is sort of like a second thing, but instead of them handing you cash, you get this accounts receivable, which will eventually turn into cash. So it isn't, so accounts receivable and revenues are connected. It's just we're going to keep them separate on the financial statement. Okay, revenues here. Okay, so revenues, that's this money coming in. And then we have our expenses. I think just these two, right? Yeah. And I'm gonna put those in as negatives because they're money going out. And what we're left over with is our net income. And this is the most important number on there. It doesn't matter that we had 22,000 in sales. It's more important, what do we get to keep? And so this net income, this is the profit. This is what we get to keep. Ooh, let's not do that. Hold on. Okay, state retained earnings. Let's skip the piggy bank for now. Let's put it in regular. So retained earnings. Our beginning retained earnings was 12,500. So statement of retained earnings, we begin with the retained earnings. We then put in our net income. So they earned another, nope, that's not right. 10,250 came in. But then the owners took some money out. They took out 1,000. And so this will give us our ending retained earnings. Oh, that doesn't look right. Yes, it does. It is right. Okay, so this is ending retained earnings. Okay, so our assets we talked about earlier, these are the cash and the accounts receivable. And the accounts receivable is when money, this is money owed to us. So this is money owed to the business. And we count that as an asset because it's going to turn into cash. So it's $20,000 when they pay us, it's going to turn into cash. So we count that as an asset. Okay. And we can total these up. So this will be total assets. Okay, liabilities. Let's have accounts payable. And no other payables on there, I don't think. Nope. And may as well total these up right now. Again, it looked kind of silly because there's just one number there, but if there's more than one number, it wouldn't look so silly and you guys wouldn't be laughing. Okay. It's total liability, so here's total assets. So now we gotta find the equity. And by the way, you can also figure out what's gonna be in the equity account already, right? I mean, you had 25,000 in assets. If you borrowed 1,250, well, you know the rest of it must have come from equity. So actually, if you know these two numbers, you kind of know this one too. Well, let's go ahead and do this one. Common stock. Okay. So this is total equity. Yeah, this is. So there's actually kind of a check on the balance sheet that you can actually figure out if you did it right or not, because it should balance at the end. All right, here, let me get screenshots of it. Okay, so that is income statement and retained earnings. And then this is the balance sheet. And again, this it balances because you're just telling, you know, how much did they got these assets, 25,000 worth of stuff. They borrowed this. And the owners paid. That's how they got the 25,000 worth of stuff. Borrowed 1,250 and the owners kicked in 23,750. Question on that thing? Okay. Joe, let's take a break.
For how long?
Good question. Let me say, like, be back at, let's say, 7:05.
Okay.
Okay. Excuse me. We got a few new accounts here. Now, yeah, this one we're gonna wanna. Or so this revenues, same as before. Now, this is a new one. Cost of goods sold is a new one. We come back here. Cost of inventory. Yeah, so that's what we're talking about. It's how much did this inventory cost? So cost of goods sold is going to be in the income statement. I'll talk about it in a second. What it actually is. So cost of goods sold, it's going out. But it's what we paid for whatever we sold. I have my visual. No, it's sort of like this. You know, here's the toy. So let's say that I'm selling toys. And I paid $2 for this, and I sell it for $5. Now, I paid $2 for it, so this would be an asset. It would be on my books for $2, what I paid for it. Right, it has a value. And I sold it for $5. Now, notice when I sell it, this is going. It's not coming back. So the cost, the $2 cost of this that I sold for $5, the $2 cost of this is leaving. Kind of like cash, if you pay $2, but in this case, it's actually inventory. The cost of the inventory that I sold is leaving. And so, you know, did I actually make $5? No, I made $5 minus the $2 that I paid for it. So I made $3 when I sold this for $5. So that's kind of the idea behind cost of goods sold. Cost of goods sold is what did you pay for it? You got to what you sold. So if I sold this for $5 and it costs $2, the cost of goods sold would be $2, and I made $3 on it, basically. Okay. Surprising that both rolls. Okay, so let's see here. So this cost of goods sold, it is not cash going out, but it's goods going out. Okay, and these expenses are just plain old expenses. And their money going out also. All right, so this will be our net income. So cost of goods sold is sort of like an expense. Instead of cash going out, though, it's whatever we paid for those goods is going out. All right, so that's our net income. Statement of retained earnings. Beginning retained earnings was 23,000. We had net income. 11,960. And the owners took out dividends. Okay, so any retained earnings is what be in the piggy bank. I keep doing that. There we go. And so this would be the most the owners could take out with dividends, 33,120 at the end. Okay. We have three assets. What are they?
Cash, inventory, and equipment.
Yep. So cash, inventory, and equipment. Those are the assets. I don't think there's any more there, is there? Or check. I think it's good. Okay, so total assets will be all those. Yep, very good. Oops, wait a minute here. So I think the total assets are that 51. $1,520. Okay, we actually have two liabilities. What are they?
Mortgage payable and accounts payable.
Yep, yep. I think I'm going to. I'm going to total it right here. So those two together would be the total liabilities. So both of those, we owe accounts payable. These are usually when you buy something like inventory or something like that. Mortgage payable is obviously when you buy land or a building or something, you're going to have a mortgage. Okay, and down here we have our common stock, just like before. We have our ending retained earnings, just like before. The equity section really doesn't change too much. Usually, out of all the sections, the equity section is the one that pretty much is the same. If you have the same people owning the place for 20 years, this will just sit there like a lump. Retained earnings will change, but the accounts don't. All right, let's see here. So total equity. Both those together will hopefully. Come up with say, and they do. So those are the financial statements. Income statement. Statement of retained earnings, which the income statement, the balance sheet kind of makes more sense. The statement of retained earnings is sort of like a piggy bank. You know, so this is kind of like what the owners they've earned, they haven't taken out of the place yet. They may never take it out. But yeah, so it's kind of like what's in their piggy bank. Kind of an odd account. Okay, any question on that? Okay, now, if you turn that file in to, not there. Nope, not there. Nope, not there. This better be it. If you turn that into, you go into this optional Zoom meeting, and we've completed chapter 1. So if you put it in there, and you can upload that file in there, and that will submit it. And you're just going to go to browse, and wherever you have it. And don't worry about it not having your name or something like that. It'll automatically have your name on it when I see it. You don't have to rename it or anything. Okay, now I'm not going to enter this because I will get a nasty comment because I'm not actually enrolled in the class. I'm teaching it. But anyway, that's where you put in those for the extra credit points. Okay. Yeah, so, oops, that's not it. So you submit it, you set it here. Okay. Question on that? All right, so we knocked out this one. How much time do we have? We'll see what we get on this other one. This class might go a little longer than usual just because being the first night. I usually try to keep it to like 2 hours. So this is handout number 2. Yeah, I should probably ask. We're doing 2 of these a week. Would you guys rather have them on different days? Do one day, one the next. I don't know if that'd be more of a pain because then you have to set aside 2 days. You know, it's hard to say. But anyway, if you want to put it in the chat, if you have a preferences, do we do 2 chapters in one day or 1 chapter twice a week? Okay. Look at this. Okay. I think it's just easier just doing it all at once, even though it's kind of it tends to be a bit long. Okay, so here's what we're going to do here. We have these transactions, and we're going to see how these transactions affect the accounts that we have. And yeah, so these are going to be the transactions we're going to use. So up here we have these transactions. These are the same transactions. And I'll do the first one. We use cash to purchase land. Okay, so we purchase land and we use cash to do it. Okay. So our cash is going to go down. Right? And our land is going to go up. So this first one, we bought land, our cash goes down by 300. Our land goes up. Okay, what would number 2 look like? Paid cash for equipment.
Equipment goes up 400, cash goes down 400.
Yep. So equipment's going up by 400, our cash is going down by 400. Supplies were purchased on account. Okay, so we didn't pay for them yet, so it's not going to be cash. So supplies were purchased on an account. Let's take
Accounts
the
payable.
good. So supplies is going to go. We have more supplies or less?
More.
More. So this is going to go up. And this is where it gets to be a little bit tricky. This will probably be accounts payable. It could be notes payable too. It just depends on how they what the on the account means. But usually it's going to be accounts payable if it's going to be for supplies, not always. And this will go up by 200 too. Now, so because we owe $200 more now. Now you'll notice something here, right? These assets, they have to equal these two, right? Those will have to equal. Now you notice this first one here, we're just taking one asset and exchanging it for another. We're doing the same thing here, taking one asset, exchanging it for another. Here's a little bit different. We actually have $200 more of assets. Now notice, if we didn't do anything else, this would not balance. The assets would be too high. But coming down here, so the assets go up by 200, the liabilities go up by 200. So the net effect of this is that they both go up by 200. So here is the they're not part of the. Here's the moral of the story to this. Whenever we do a transaction, to keep in balance, at least two things have to happen. You know, there has to be at least two accounts. There could be more, but there has to be at least two accounts, or else it's not going to balance. Accounting is sometimes called the double entry system, is that if you put one thing in, you know, whatever account it is, if you change one account, something else has to change. So it's a double entry system, and it has to be, or else it's not going to balance. Okay. So let's go to number 4. Oh, number 4 is a good example. More than one account.
Not too mad. You look at the picture. Girl, I have thousands of pictures. Don't nobody be
You're on.
what you
You're not
doing.
on mute, Jasmine. You're not on mute.
I'm so sorry.
Oh. All right. Well, the number 4. Now you're not on mute. So number 4, what's that going to look like?
So the mortgage payable is going to go up, and building is going to go up 2,000, and land is going to go up 1,000.
Yep. And again, this would still be balancing because we're adding 3,000 to the assets, but we're also adding 3,000 to the liability, so it'll still balance. And in this case, they have more than two, they have three accounts. Borrowed cash from a bank using a note payable, 5,000.
Well, then notes payable will go up 5,000 and cash will go up 5,000.
Exactly. Yes and yes. Yeah, we owe 5,000 more of this note, but the bank gave us $5,000 for whatever reason we're gonna use it for. Six is kind of a tricky one. Issued common stock for cash. Issued is the same thing as sold. So we issued it, that means we sold it. We sold it for cash. All right, well, let's take the easy one. I'm gonna do something here. I'm gonna freeze these frames. I gotta all this. All right, so number 6. We sold common stock for cash, so our cash is gonna go up by 2,000. What else is gonna happen? Now, notice this is a little different than like selling merchandise. We sold this, we're actually selling ownership in our company. When we sell stock, we're selling ownership. So we're gonna come down here. This would be $2,000 more. We have $2,000 more worth of owners, basically. So we got $2,000 worth of cash, and we have $2,000 more worth of owners who bought into the company. Received cash from a customer previously billed $500. Our cash is going to go up. Now, if they paid us, they don't owe us anymore. Right, they owed us 500, they just paid us, so they don't owe us anymore. Number 8 is the same thing. Customer paid cash towards their account. I think I put both those in. I think there was something in the handout about it. And not the handout, the homework. Customer paid cash towards their account of $100. Same thing. Different wording, same transaction. Excuse me. Okay. Number 9, paid off a few accounts payable. Paid off a few accounts payable.
Accounts payable goes down by 400.
Cash goes down. And accounts payable also goes down. We no longer owe them $400 of whatever we owed them before. Yep. Okay. Okay, and the last one, number 10. Maybe payments towards mortgage payable 1,000.
Mortgage payable goes up, cash goes down.
Cash goes down.
Well, mortgage payable goes down technically, but we'll put it like without the negative.
No, well, no, it'll actually go down. It'll be negative.
Oh, okay. So you do add negative.
Yeah. So whatever whatever we owed them, we owe them 1,000 less now. Yeah.
Okay.
So it reduced the mortgage payment, let me put it that way. Yeah, paying off the liabilities is one that is probably the most difficult to think about, but it's. When you because we're all, we're tempted to say, okay, I borrowed money, so that means I owe $5,000, but actually, that'll be negative, but actually it's plus then. So if you,
I thought that we would be putting it as a debit, basically, since we're already implying that those accounts are negatived out, so that it can turn out to be zero at the end.
yes,
Like-
you're absolutely right. If you were doing the journal entries, you would be debiting the mortgage payable, which would be a reduction of the liabilities.
Yeah.
And you're right, the journal entry would not have a negative. The debit side of it would indicate that it's negative. The nice thing about this class a little bit is that we're not going to do journal entries. So the idea is exactly the same, but journal entries, if you ever had accounting before, probably the most confusing thing about it, or one of them anyways, is journal entries. Journal entries is really like a 400-year-old shorthand that, they used to be journals you'd actually write out. We bought 700 bales of corn or whatever it was. I guess they didn't have bales of corn, but they'd actually write it out like a journal, and then they kept shortening it until we got what we call journal entries, which are really just debits and credits, but we're not going to do debits and credits in this class. The idea is exactly the same. It's just we don't do the shorthand, but you're absolutely right. That would have been a debit to mortgage payable, and you would not have put a negative in the journal entry. Okay. All right, let's go ahead and do this one. Now, this one gets to be a little bit confusing, but we'll go through it. Okay, received a utilities bill. $200. Now, this is where it gets a little bit confusing. So we owe $200 here.
Would it be, wait, oh, it would just be accounts? Okay, I thought, never mind.
Yeah, so it'd be some kind of a payable. So a utility bill, whatever, some kind of a payable. And quite honestly, I mean, at least in my classes when I teach, it doesn't matter. Liabilities are liabilities. But anyway, yeah, so we owe $200. Now we haven't paid it yet. It doesn't say that we paid the bill. Now, this retained earnings. Anything that is a revenue or an expense or dividends will go through retained earnings at the end. And you remember from our previous one here, all these revenues and expenses go into net income goes into retained earnings. Okay, so same kind of thing here. Now I'm going to make this a little bit more user friendly. Revenues will add to retained earnings, expenses will subtract, and dividends will subtract from retained earnings. So these, we should get these a little closer. How about? Hey. So these three things, any of these three things will go into retained earnings. Now, utilities is going to be an expense. So you're going to have utilities expense that's going to be a negative. Like this is the income statement here. So this will be a negative. So this will be minus 200. You know, who pays for the utilities? The owners do. We owe employees for 1 week's worth of wages. 1,600. So we owe them. What's the liability going to be?
Wages payable.
Yep, and we owe them 1,600. And we're probably gonna have wages expense. In fact, I'm gonna put these in down here underneath. Scooch this up a little bit. So this first one would be utilities expense. This one would be wages expense. Okay. Sold common stock to investors. I think we already did that one, the previous one. So we sold common stock to investors. What's that gonna be?
We're gonna put common stock and then cash.
3,800. So we have 3,800 more of owners basically, and we have $3,800 more of cash. Okay, perform services for cash. 280.
Just skip one.
I skipped one. Oh, I did. Sorry, pay dividends to stockholders, 1,800.
Cash would be 18. Well, no, we'll credit cash.
Yes.
And then I'm not really sure.
And then this will be coming out of retained earnings, will be dividends. Now, the one that I really wanted to do was 15. Perform services for cash, 280. So we did some kind of work and they paid us $280. Well, let's take the easy one. What's going to happen to the cash? Go up or down?
Cash will go up.
Yep. And this would be a revenue. This is whatever we're in business for would be a revenue. Services, something, you know, it could be service revenue, it could be this revenue. Some kind of revenue. Home service. I like to spell it without an R, but sometimes people spell it with an R, so. Okay, so service revenue. So like on the income statement, this would be a revenue of 280. Okay, billed customer for services delivered. So we did our service. And whatever it was we were supposed to do, we did it. And now we hand them the bill. We have not got the cash yet.
Would it be accounts receivable?
Yep. So accounts receivable is going to go up. They now owe us
And then
550.
retained earnings, 550.
Yep. And so they owe us $550. They haven't paid us yet, but we will. We're counting it as a, excuse me, as an asset because we did our part. We earned this money. And when they pay us in cash, it's going to, our cash is going to go up. So it has a value to it. And this will be some kind of a revenue too. So whatever you do for money is basically a revenue. $17, services made to customer. That doesn't make sense. Services made to customer, probably for customer maybe. On account. It's basically the same thing. It's on account, they didn't pay us yet, we did services. I'm not sure why the made is in there, but anyway. So there's a made pay 810, so they haven't paid us yet, so this will be 810, this will be accounts receivable. And down here, 810. Oops. That's also service revenue. Paid current month's rent, 2,200.
We would credit cash and debit mortgage payable.
Yep, so our cash is gonna go down. Now, I don't think. It depends on whether we already had this on the books or not. But I don't think they said that we had it on the books already, so I'm gonna put that as a rent expense, I think. Yeah, if it was on the books, if we had rent expense and rent payable, we pay the payable. I did this wrong. What's wrong about my expense? Do owners like expenses or not like them? They hate them. It should be a negative. So rent expense should be a negative. Revenues are positives. Owners like revenues. They hate rent. Yep. Yeah, exactly. All right. Purchase supplies on account.
Accounts supplies goes up and accounts payable is debited 160 credited.
Yeah, it's credit. Yeah. So the right one. Yeah. So 160. And we owe 160 million. And that one's real, I know it's tempting to put that as a negative, but this is how much do we owe? So it goes up when we own more. The only way we have it go down is when we pay it. Oh, like we do at number 20, we pay for supplies. Purchase on account 160. So what's number 20 gonna look like?
Cash would be credited 160 and yeah, and then I guess
It would be a debit, but yeah, it's negative 160.
yeah.
So cash is going down by 160 and accounts payable is going down by 160. And so these are kind of the transactions and how they A transaction changes this, basically. You know, how do these change? How does cash change? How does accounts payable change? How do stocks change and all that kind of stuff? That's what this one is explaining. Like when a transaction happens, when a transaction is anything that's going to change those financial statements, change an account, and it always has to change at least 2 accounts. It could be more, but at least 2. Okay, I'm gonna let you guys get a screenshot of this. Give me 1 second. Okay, so this is page 2. I get a screenshot of that. And let's do the same thing for page 1. Page 1 is bigger. Anyways.
You zoomed in.
Okay, so this is page 1. Okay. Last thing, yay. Ratios. And by the way, when you're taking tests, you can have these handouts out. So if they ask for a ratio and you're taking a test or homework, you can use these. Just plug in the numbers. It'll give you a percentage. Hey, these are not set up. I think I gotta put the formulas in for those. Rats. I thought I had that all set up for you guys. I guess I didn't. Okay, so return on equity. This is the first one here. Return on equity. Round percentage to round to 1 decimal place. Okay, so we start out with our net income. So 2021, we had net income of that. And shareholders' equity. That. And I stupidly did not put a formula in there. Maybe I did that on purpose. I don't think I did on purpose. But anyway, so there would be return on equity. 25%. 2022. $62,000, the equity was. I'm going to copy this. And so the question is, are we doing better in 2021 or 2022? The general rule is if there's something good on top that the owners want, like income, you want it to be high. That's not always the case, but that's usually the case. So if there's something good on top that you want, so net income, we want net income, so you want this to be high. So we would say they're doing a little bit better in 2022. So hope they agreed. Hey, you can't see it. Hold on, let's try it again. Okay, return on assets. Net income, well, the net incomes are the same here. So this will just be 50,000. Total assets. Oh, that's probably why he did it, because you get these error messages. All right, so our return on assets is 13% in 2021. And in 2022, it's 16%, which is better. Not more. A better, return on something. How much do you get back? And I tell you, the idea behind ratios, which you guys probably already know, is that it's kind of like making sense out of the numbers, basically. Okay, net income. Over sales. And again, return on sales is better. Total assets to shareholders' equity. Actually, we get over here. This one, it's hard to tell whether it's better or worse. Now, generally speaking, the lower the number here is going to be better. And you might say, well, wait a minute, aren't assets good? Yeah, they are. But the problem is that the difference between those is going to be for liabilities. So the more assets that you have, how's the best way to say this? The ratio of that is that the more you have in your equity, the better. So the bigger this bottom number is, the better. The lower this is. But there is a weird kind of dynamic to this. And that is, companies that are more secure are generally less profitable. So the more secure something is, the less profitable it is, because there's a risk reward thing going on. So a lot of times, they did modeling where they said, okay, which company is the most profitable? One with a lot of debt or one with little debt? What's the most profitable? What they find out is that what really is happening is the risk is changing, which changes your income. So that you can be more profitable if you have more liabilities, but it's also riskier. Bigger chance of going bankrupt, obviously, with a whole bunch of liabilities. Whereas you're nice and safe, you don't have any or very few liabilities, you generally are not as profitable. So it's kind of a strange thing as to whether it's really, which is best. It is safer to have more assets than liabilities. Okay, that's sales. Excuse me. And total assets. And this one will also be a little bit better in 2022. It's a little bit higher. But anyway, when they ask you, so they ask for these ratios, you feel free to use this in the homework or taking your tests or whatever. There's a whole chapter on this that we'll do later. But they pull some of these off right in the beginning. I'm going to do something here so that we have this on the same sheet. Okay, so go ahead, you get a screenshot of that. The numbers you're looking for over here. Okay. Any question on that? Okay, well, so now both of those are done. And you can submit both of those and get 20 extra credit points.
Is there a deadline for submission?
Nope. This course is done at your own pace. So whenever you turn it in is fine, but everything needs to be turned in by. Sorry about that. Everything needs to be turned in by. I think the last day of class is the 10th. I think I have it open though until the 17th of July. Let me put that in here. And so everything is open though. You do it at your own pace if you know however you want to do it. But everything for the class is due. So the last day of class is the 10th, and I think I leave everything open until the 17th.
Oh, June.
May the 17th.
Yeah.
Oh. Come in that time machine and then go back and say, oh, okay, no, you don't have a time machine? Okay, we'll go to July then. For those of you that don't have a time machine, I didn't realize you didn't have a time machine, so yeah. All right, yeah, so everything is due. I think the actual last day of class, and I think this is, I can't remember if this is in my business course, it is the 10th but I think I have until the 17th to actually enter grades, so I think I leave it open until the 17th. There's always something that comes up and someone can't get their computer to work or whatever, you know. So, yeah, there's no hard deadline now. The only thing I would encourage you to do is to keep kind of on track. What I mean by that is, so next week we're going to do the chapter 3 handout and chapter 4, but the first test is over chapter 1, 2, and 3. So I would encourage you to try to keep up. This class isn't too bad if you kind of keep up with it. It tends to get, you know, even taking a week off can kind of, you know, really put you back a little bit. But anyway, but everything is recorded. So like this Zoom meeting will be up there probably by 10 o'clock, but certainly by tomorrow it'll be up. And you can always go back and look at the stuff to catch up with it. So if you did miss a week or two or whatever, you can catch up on the extra credit points, but also the course itself. There's nothing that has a deadline, a hard deadline that's not the end of the term. Any questions? So next week I'll probably give you guys a reminder. Oh, by the way, maybe make sure you get the chapter, the first exam in chapters 1, 2, and 3, and get the homework for chapters 1, 2, and 3, and that would be kind of keeping on track. It's a fast course. You can't rest. So, any questions?
You recommend to read the chapters, right?
I recommend only doing what you need to do the homework, and taking the exams. These textbooks are similar to other ones in that they overload them, the chapters. And they do that for a reason. They try to selling textbooks is like selling anything else. You try to get as many customers as possible. So if you have a customer that says, gee, this chapter 1, I really wish that you had something in there about, you know, I don't know, selling corn. Well, guess what? Something about selling corn gets put into chapter 1 because maybe it's a big account and, you know, they want to sell. The whole purpose of making these books is to sell them. So a lot of times there's things in there that are not necessarily even what the author would put in, but they're trying to sell books. That's, you know, kind of where they're at. So I would say read what you need to, you know, and when you take the test, you know, there's nothing wrong with having especially if you have the ebook, if you have that pulled up on a different screen or something like that, no problem that you don't remember, hit the glossary, see what they're talking about, and answer the question. You know, take advantage of it. Yeah, or you can even Google it sometimes. You know, a lot of times accounting is pretty standardized. So a lot of times, unless you had some funny term, which I think there's too much in here like that, you should probably get you close to the right direction, to put it that way. Don't go to like Facebook or something where you get crazy answers, but you know, go to regular websites. And quite honestly, you do searches for a lot of accounting terms, you get usually financial websites, things like that.
Right, thank you.
Good. Yeah, so everything's wide open. You can work ahead if you feel like you know the stuff. You don't need, you know, you can. There's nothing wrong with doing that either. So it's kind of going your own pace, but as long as you're done by July 17th. Okay. All right, well, I will see you guys next week. If you have any questions, feel free to email me or call me or text me. But other than that, I will see you guys next week, and we'll do chapters 3 and 4.